In a world driven by money, power is built in silence. Empires rise, markets fall. This is Behind the Money.
September 2008. Within days, some of the largest financial institutions in the world began to collapse. Stock markets crashed. Banks stopped trusting each other. Credit froze. And for a brief moment, the global economy stood on the edge of total collapse. This wasn't just a recession, it was a financial heart attack. This is the story of the week the world almost went bankrupt. To understand the crash, we need to go back. Early 2000s, interest rates were low, money was cheap, and banks were eager to lend. In America, owning a home was more than a goal. It was a symbol of success. Banks began offering mortgages to almost anyone. Good credit? Approved. Bad credit? Approved. No income? Still approved. These risky loans were called subprime mortgages, and at first, it seemed harmless. Housing prices kept rising. Everyone believed the same thing. Home prices would never fall. But behind the scenes, something dangerous was happening. Banks weren't just giving mortgages, they were packaging thousands of these loans together and turning them into financial products. These were called mortgage-backed securities. Then they were sold to investors around the world, pension funds, insurance companies, even foreign governments. The risk was spread everywhere, and because housing prices kept rising, no one questioned it. Credit rating agencies labeled these investments as safe, but they weren't safe. They were built on loans given to people who couldn't afford them. It was a ticking time bomb. In 2006, housing prices stopped rising. Then they started falling. Homeowners with adjustable rate mortgages suddenly faced higher payments. Many couldn't pay. Defaults increased. Foreclosures exploded. Now those safe mortgage securities? They were losing value. Fast. Investors realized something terrifying. No one knew how much these toxic assets were really worth. Banks stopped trusting each other, and when banks stop trusting, the entire financial system freezes. September 15th, 2008. Lehman Brothers, a 158-year-old investment bank, filed for bankruptcy. It was the largest bankruptcy in U.S. history. The message to the world was clear. No one was safe. Markets panicked. The Dow Jones dropped hundreds of points. Money market funds, once considered ultra-safe, began breaking down. Businesses couldn't get loans. Companies couldn't make payroll. Fear spread globally. Europe, Asia, everywhere. The financial system was bleeding. For a few days, the global economy was dangerously close to total collapse. Credit markets froze. Major institutions like AIG were hours away from failure. Governments faced a decision: let the system fail or intervene. The U.S. government launched a massive bailout program, $700 billion under the TARP program. Central banks injected trillions in liquidity. Interest rates were cut to near zero. It was emergency surgery on the global economy. The crisis triggered the worst recession since the Great Depression. Millions lost their jobs. Millions lost their homes. Global trade collapsed. Trust in banks shattered. And governments increased regulation across the financial system. New rules, stress tests, stronger capital requirements. But the damage was done. The world had changed. The 2008 crisis wasn't just about bad mortgages. It was about greed, complex financial engineering, lack of oversight, and blind optimism. It showed how deeply connected the global economy had become, and how quickly confidence can disappear. Because in finance, everything works until it doesn't. And when trust collapses, everything collapses with it. This was the week the world almost went bankrupt. and it changed the global economy forever.